2023 edition of InvestTalk. And once again, welcome back. Hope everyone had a wonderful Thanksgiving holiday extended weekend. It felt longer than it normally did, at least for me. I'm Justin Klein, and it is Monday, and that means we have Luke Guerrero back with us. Luke, how was your Thanksgiving?
I am still full from Thanksgiving.
So
and I hope that all of you are as well.
All right. Well, we are here, and we are ready to answer your questions and make you a better investor by giving you actionable data as well as a perspective developed with over 20 of investment experience. And we're going to talk about the market performance today. We can run down some show topics, but right after we answer our first caller question.
Hi, Steve, Justin, and Luke. This is Brett from New Jersey. Thanks for all you guys do. I'm a longtime listener and love the show. I wanted to reach out about a company called Cardinal Health, ticker symbol CAH. I bought it a while back. I'm up around 100% right now, and I was just wondering, you thought the company still looked good? I want your input on it. You think I should trim? You think I should sell? Or just let it ride? I'd love to hear your answer, and I'll look forward to it on the show. Thank you. Bye.
All right. Cardinal Health. This is a name that has been on a tear as of late. It's certainly overbought. It's at a 52-week high. Its revenue growth is decent, kind of mid to low teens over the past year or so. But it's really the earnings growth that has improved. Margins are certainly improving. Luke, are you seeing anything on your?
I'm seeing that the price to earnings, the forward-looking price to earnings, is 14.6, which is well over its average of 10.3. From a debt financing perspective, I mean, it looks good. It doesn't have much debt. It looks like its earnings do a good job covering it. I'm seeing that a couple of its bonds are trading at a deep discount, which can be a worrying sign if investors believe there's some credit risk, but I'm not exactly sure why those are trading at a deep discount. But that might be something.
Are they long duration? Could be it.
That could be it. No, it certainly could be it. I haven't been able to figure out why in this brief time.
Yeah. Well, Cardinal Health, for everyone out there, they are they're mainly a pharmaceutical company. They are fairly diversified. They're not just based on pharma. They have both branded and generic and specialty pharmaceutical drugs. And let's see. They also are well diversified globally: North America, Europe, and Asia. So, this is a name I really have to dig into what's happening here because it's certainly overbought. It's certainly, like you said, Luke, trading at higher multiples than historically has, which gives me a lot of pause. There tends to be, in most situations, the business remains static, meaning it can ebb and flow with the cycle or for various short-term reasons, but typically margins over time average out. And this is what the thing is. It's one of the makers of the GLP-1s. So I believe it's an Ozempic competitor. And I've said this many times. I'm not a fan of this. I've seen this playbook before. Just like I saw Peloton. Remember Peloton? People ended up putting their dirty clothes, right? And it wasn't used. And that's kind of what's happening a lot of times with Peloton, and that's why they are creating. And I've seen this fad in the 90s, early 2000s, different drugs that come out and that get hot, and they have their side effects, and they crash and burn, and everyone's on to the next thing. And that's exactly what is going to happen with these. There's major problems with digestive issues, and therefore I am not jumping on this bandwagon. I wasn't aware that the competitor was Cardinal Health, but it does look like they do sell another GLP-1. So I'm absolutely passing on Cardinal Health at these valuations. All right. Now let's pivot over to Sam in Dallas. He's looking at WBA.
Hey, Justin, this is Sam here. Thanks for taking my call. And before I start my question, thanks to you and Steve for this education that you give to all of us through daily podcasts here. My question is about WBA, as you said. They are actually on a downfall for some reason. I know there was a recent CEO change at Walgreens, and they offer a very good dividend. I have taken a position at around 24, like a few months back, but I see that they're just sliding down, and they're at around 20 right now. And I'm thinking, should I, add on to my position, or should I wait for some more time? So I just wanted to know some thoughts from you on this WBA.
Well, this is very simple. What you're doing is you're yield chasing. And as I said many, many times over the past months and years, is that when you are getting above average dividends, you're taking above average risk more often than not, especially when you're getting these yields that are close to double digits. And right now, the current dividend yield on Walgreens is close to 10%, about 9.5%. That is way, way too high, and so is their debt level. So they have a ton of debt. Their profitability is now negative. Operating margins are negative 5%. And what's going to happen is that dividend is going to get cut. Why? Because they are going to try to service that debt before they try to continue to pay that dividend. And the market is pricing in that dividend is going to go away to some degree. Now, maybe it's only cut versus eliminated, but more often than not, What happens commonly is they go from right now the dividend yield is 48 cents per share, and it's probably going to get cut to like a penny, right? That happens a lot too. So we're still paying a dividend, but now it's next to nothing until they get back on their feet, they right size their balance sheet, etc., and boom, then they can raise that dividend once again. But that may be many years down the line. The technicals are horrendous. The relative strength is 12. It's creating what we call a bear flag. It's been kind of sitting around the support level around $20 for now 3 months and getting ready to probably break lower. So the first thing I would do in the morning when you wake up is log on and sell this. This is, I would say, if it didn't pay a dividend, it would be a pretty good short candidate because this is headed down fast. So you want to run away from these type of names in this environment. Okay. Now we're going to a quick break. Please remember that you can call anytime and leave a question on the InvestTalk Voice Bank. If you're listening via the live stream or on AM 1220 radio in the Silicon Valley area, you can call right now at 888-99-CHART.
When listener questions are played on the InvestTalk podcast,
how do you guys determine a value stock?
The caller voices are amplified many thousands of times.
Just wanted to get your opinion on JP Morgan and BAC.
How do you see this looking forward? I'm 25 years old and have a question about retirement funds.
And the unbiased answers from Justin Klein.
That's why it's trading so cheap, because there's a lot of regulatory risk.
And Steve Peasley.
I kind of like it here. If I was going to buy Tyson Foods, this is where I'd buy it.
Benefit the entire InvestTalk community.
Thank you for what you guys do.
That's why 24/7, rain or shine, no matter how simple or how complex, your questions make a difference.
Symbol BKE. What's your outlook?
And InvestTalk is made better by the power of you. So don't forget to call 888-99-CHART.
So this is what we have planned. Our focus points set up by this headline. What is infinite banking and how does it work? Now, the infinite banking concept is something that is going to be pitched to you at some point, probably in your life. So I think it's important to touch on advantages, disadvantages, kind of the pros, basically this is whole life insurance or permanent life insurance, variable life, etc. And we'll talk about this private banking strategy and the infinite banking system step by step. And of course, the advantages and disadvantages of infinite banking. All right, we also have some other topics to discuss. One is Cyber Monday. Today is Cyber Monday, so we're going to look at the recent trend in holiday sales and what that looks like and how that will feed into potential profits. Also, a somewhat worrying trend, or a trend that definitely colors the jobs data that we are seeing in the market today, and that is in regards to the healthcare industry. And that has really been driving the job creation over the past 6-9 months. And we're going to look at the numbers there and decipher the data. Also, the SPAC bubble. We are now, Luke, would you say the SPAC bubble is gone? I think it's behind us now, or is there more comeuppance to come?
I think as long as there's an appetite for things like that, there'll always be some more comeuppance to come, especially as capital standards get looser.
Yeah. Well, we're going to look at the recent history and what it can teach you about those that are pitching big ideas. All right. We also have some voice bank questions. One is in regard to selling options, and the other is PubMatic Incorporated. We also have perspective today. It looks history of pension plans in America. But let's take a look at the market performance today. Now, Luke, coming off the holiday, we had a kind of a mixed market. Overall, it was generally down, though, right?
That's correct. I would say overall it would be uneventful. I think the market is as sleepy as the rest of us, having those food hangovers from Thanksgiving. Not much news in the way of today. Everything was lower, but generally not too low off of worse levels midway through the day. But I think all eyes will be on the personal consumption index, as there has been a lot of talk about how consumer spending behaviors may change going into the holiday.
Yeah, and that is Thursday, I believe?
It's on Wednesday, I believe.
Wednesday, okay. It's Wednesday or Thursday, I know that.
It's one of those days.
Yeah, the big economic number today was on new home sales. It didn't really make it, though. The ITB, the home construction ETF, that was slightly down, roughly flat for the day. Overall, the market is overbought. We've had a big move off of good support in late October. And just in about 3 weeks, we've erased almost all of that market pullback in August, September, and October. And that leaves you in an overbought situation where there needs to be some level of pullback or consolidation in order to kind of reach that next level of resistance, which would be, frankly, that not all-time high, but the high to beat the July high. So it'll be interesting to see what that looks like. We are in the midst of Santa Claus season. You typically get a low volume float in the month of December, especially in years where the market is up. Last year the market was down, so you had more of a sell-off into year end. This year, even though we're overbought, odds are still pretty good. I think you get a rally, a modest rally, very modest rally into year end. You had the dollar week. That's obviously positive for risk assets. You had the 10-year. That was down as well today, down 8 basis points after a decent increase on Friday. And so a pretty interesting kind of sleepy, I guess, not interesting, very boring market today with the dollar week. And we'll see as we go into, what are we, 2 weeks away? Almost 2 weeks away from the next Fed meeting, so that's coming up fast as well. All right, we're going to a break. We're here ready for your questions. So give us a call now on InvestTalk at 888-99-CHART.
Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
Now, our focus point today is set up by this story. What is infinite banking and how does it work? Now, we're highlighting this mainly because you're going to get pitched this at some point or some form of this. And put simply, this is having a whole life policy, whole life insurance policy, and having the ability to take a loan out against it. Now, they'll pitch you that you are essentially becoming your own banker, that you're going to pay interest on the loan, and that's going to basically deduct from the cash value of your policy. So if you are going to use leverage, that this creates a pool of capital that you can borrow against. And, investing in, or I don't want to say investing, because I think it's a poor way to describe it. But buying a whole life policy consists of three components when you put that money in compared to a term policy. And that is you're paying for fees and operating costs. That's one. Those are usually high. A portion is to cover your death benefit. That's basically a term policy. And then the cash value portion, which builds over time, which is kind of like an investment account. Now, what they won't tell you too is that the investment account is invested in high fee funds typically. Now, there are usually minimum gains and things like that. Every universal life policy is different. But the story that they're going to pitch you is that now you can borrow against that cash value if you ever do need the money. You want to go buy a house, you want to lend money to your family, whatever, you don't have to run a credit check of the one. You can do that. You don't have to justify it to some bank for whatever reasons. But Luke, typically the disadvantages outweigh it in a big way. Number one, you can defer taxes, but usually that is only for those that are in high tax brackets. The benefit is best for those that are in high tax brackets. Most people are not. And then your monthly premiums are way higher. A term policy is oftentimes 10% of the cost of a whole life policy. And the salespeople aren't going to tell you that because they get much better commissions when they sell you a whole life policy versus a term policy. And they won't tell you that the amount you'll save is likely to grow much better outside of that life insurance policy than inside of it. So, infinite banking.
Sorry, could you say that again? You cut out a little bit.
Have you ever heard of the term infinite banking?
I personally have not heard of the term infinite banking, but everything that you mentioned and everything that I've read about it, it seems to be one of those things where it's very important, again, to understand where you're putting your money. So like you said, you do have the transparency of knowing what those assets are invested in, but they tend to be of a certain amount of options that are given by the insurance provider and are likely to be, like you said, in high fee investments. So my question for you, because maybe you know more about this than I do, is the interest rate that you can get from borrowing off of that cash value any better than the low interest rate you can typically get from borrowing off of your 401k or retirement account?
Typically, no. And also what they're going to pitch you is that money can still grow. Right, there's the arbitrage between what you're going to earn on those investments versus what your that amount, right? So they try to get you with kind of a gimmick in a way, but in reality, you could have taken that money, that 90%, you could have spent 10% of what you would have on a whole life policy. Right, and buy a term policy, and you can go invest the rest in your 401k, in your IRA, in a brokerage account, and grow that a lot better. And then if you need the money, you're not paying any interest, right? You're just going and using that capital. So, these are and it takes a lot of commitment too. You have to commit to a high premium for a long period of time because until you actually get some value in that cash value side of the whole life policy, you can't borrow against it. So it usually takes 7-10 years before you actually can get to that point because of those high upfront costs. Remember, insurance companies paying the salesman usually 9-10% commission, etc. And that's not something that they're going to tell you. And so until they can make that up, your cash value isn't really going to be there. And then, like I said earlier, a lot of people look at, it's kind of like the what do you call it? The municipal bonds and how people want to avoid taxes. People buy the usually it makes sense for the brackets. All right. Now, the next Invest Talk, we'll look at a story set up by this question. Can the rally for growth stocks last? That's tomorrow, but for now, I'm Justin Klein, ready to take your calls at 888-99-CHART. The holiday season is a special time, and maybe you want to connect more with family members, some of whom are not native English language speakers. Or you might be hoping to land a new job, and picking up a second language could make you a more competitive applicant. Or perhaps you have an upcoming international trip. There are many reasons to learn a new language, and Rosetta Stone is the world's most trusted language learning program. It teaches through immersion instead of memorizing and drilling vocabulary words. You learn by matching audio from native speakers to visuals, reading stories, and participating in dialogues. Rosetta Stone has a built-in, patented speech recognition engine called True Accent. So as you are practicing speaking, you'll get feedback on how well you are pronouncing words. Rosetta Stone can be used on desktop or as an app, or you can download lessons for offline use. Rosetta Stone helps you tap into your brain's innate ability to learn language. In fact, with millions of users, Rosetta Stone has helped all types of language learners reach their goals. Don't put off learning.
No two portfolios are alike, and every investor has a unique set of circumstances. So don't forget to call InvestTalk, 888-99-CHART.
Hey, Stephen Justin, Bill from Philadelphia here. I'm calling about PubMatic, ticker symbol PUBM. They are a programmatic advertising platform, and they just had their earnings in last week and did really well. I picked some stock up before the earnings, and wanted to get your thoughts on if I should keep this as a longer hold, sell off a little. Just wanted to kind of get your thoughts about the company and technicals. Love to hear what you guys think, and love what you guys do. Thank you so much.
So the question is about PubMatic, which engages in the provision of specialized cloud infrastructure platforms for advertising transactions. So from a general thematic question for PubMatic, we like cloud infrastructure companies. If you look at what has happened with Alphabet or Google, or with Microsoft, you see that the cloud divisions of those companies are doing very well. But when we're looking at this from a pure technical perspective, it looks like PubMatic is actually pretty weak, its relative strength. It's underperformed the S&P. And to me, it looks like over the past 1 month, we've had some price discovery, probably related to those earnings. So I would say until it's discovered a new support, it would be a pass for me.
All right. I am back. I had some technical issues, so let's grab another call.
Hey guys, this is R from Tucson. I am circling back to take one last look at PLBY Group, Inc. That's PLBY. Wondering if there's any value left here at 46 cents a share. Or is this thing, should we just let it die? Right now, it seems like if you were going to buy it, hard to see it getting much cheaper than this. So just wondering if there's any risk-reward value here, and if it's worth taking a small stake on, or if we should just forget about it for good. Thanks, and I'll listen on the podcast.
This is easy to answer. The management team is terrible. They have a great brand, and they drove it into the ground with doing too many things at once, and not focusing on really extracting the most value from the brand. So, nope, not a place to invest. All right, now let's touch a bit on our perspective for the day, and that is in regards to pension plans in the United States. I love history, so I love looking back at these things that most people take for granted, and they don't even know where they came from or where they started. And the first evidence of a pension, Luke, goes all the way back to the Roman Empire, which I know you think about every single day, right, Luke?
I didn't think about it today, but now I have, so thank you for this.
There you go. Well, that's in the 1st century BC was the first pension plan. And typically these pension plans were designed for veterans of wars or set up by community churches. And there were more charitable initiatives. Now, the first veterans pension plan here in the United States was offered to naval officers in 1799. So that was, if you think about it, not that long ago. But the first private pension plan in the United States, I bet you nobody knew this. I didn't even know this. 1875. And it was the American Express Company. Obviously, at that time, they were not a credit card company. But once again, not that long ago, 150-ish years ago. Now, by 1970, 26.3 million private sector workers, about 45% of all private sector employees, were covered by some kind of pension plan. That's incredible. Did you ever think it was that high, Luke?
No, that's pretty wild. I do remember from studying for the CFA pension accounting. So I wish that back then they didn't come up with pensions, because that's the worst part about level 2.
Absolutely. Yeah. Pension accounting is almost torture. Would you call it borderline torture?
About as close as you can get without violating the Geneva Conventions. Yes.
Exactly. Yeah. Now, pensions in the United States consist of the Social Security system. Systems, CalPERS is the largest, as well as you have private pension plans offered by employers still. There are still some out there. My mother has one. She recently retired. Insurance companies, unions, they have offer some pension plans as well. Now, starting in the 1980s, pension plans rapidly began disappearing. Why? Because of 401k plans. It was a lot easier to know exactly what you were to put into the 401ks, do a little bit of matching, and never have to worry about pension accounting again. That's probably the main driver, I would think, right, Luke? Like being a manager of a company and not having to deal with the pension accounting again. It's a pretty big incentive there.
Yeah, I think that's correct. If you look at what happened with General Electric when they decided to turn what was a industrial company into one that focuses on capital with GE Capital, that wasn't a good business move. So certainly for a lot of these companies, managing internally or hiring consultants to do it and having to carry that on their balance sheets is just bad for business.
Yeah. Now, as of 2020, Social Security was the most common source of income in retirement. 81% of retirees had one or more sources of private income. 59% of retirees with income came from a pension, 56% from interest in dividends and rental income, and 32% of retirees had some sort of labor income. So still kind of working to some degree. So I guess you call them semi-retired. Now, the average retirement income as of 2022, monthly, $4,381. $4,381. Now, everyone's situation is different, but more people get pensions than you realize, especially if you consider Social Security. All right, now let's talk a bit about what today is. It is Cyber Monday, Luke, and spending is set to reach $12.4 billion. That would represent an increase of more than 5.4% compared to last year. And if you look at how people were spending this holiday weekend in general, Black Friday sales in stores and online rose 2.5%. Now, online was the big winner, 8.5%. In-store sales just up 1.1%. But what's interesting is that experts think the best deals are yet to come. Have you spent a lot this weekend?
I have actually spent nothing this weekend. That's not true. I bought golfing tees and a tripod so I can fix my terrible swing. But other than that, I haven't really spent more than $40 this Cyber Monday. And for me, this is good news. It points to how much the consumer is still able to spend. Hopefully, they're not putting it all on buy now, pay later. That would be bad. But
don't tell that to a firm.
That's true. I think that a lot of people probably spent Black Friday with their families, whereas I was obsessively checking to see if consumers were going to stores, the brick and mortar stores, to spend money as an indication of what that meant about consumers' purchasing power. So after anecdotal evidence came in with brick and mortar stores having far less foot traffic than normal, this is good news. This is good news.
Yeah. And last minute shoppers are expected today to spend about $4 billion between 6 p.m. and 11 p.m. Eastern. So basically right now. And you're starting to see some of the retailers drop their prices even more. Walmart, for example, they upped their discount on clothing from 50% during Black Friday now to 60%. So that's one indicator they're trying to unload inventory. And once again, experts are expecting that the best deals are still yet to come. And it'll be interesting to see how much that pressures margins, because it's not just about the top line, but what that bottom line looks like as well. And with inflation still there, right, lower than we saw last year, but still there is some inflation, and it'll be interesting to see what type of margins these retailers end up with. I think overall it'll be a solid holiday season. Not amazing, because I do think there are a certain subset of consumers that are tapped out, that are maybe a bit more worried about their job security than they were this time last year. And the income growth compared to, especially on the younger cohort, isn't as good as it was last year. And so I think those three things are going to kind of make a holiday season that is fine, but not amazing. All right, let's swing back to the InvestTalk voice bank for this question that came in earlier on 888-99-chart.
Hello, InvestTalk. I have two questions about selling options. The first one, you could just kind of go yes or no, but after you collect premium when selling options, does that premium go towards the cost basis for the underlying stock that you are selling calls against? And then second question is a follow-up question from a previous caller about what you guys look for when picking stocks to do a covered call strategy on. And I was just looking to see if you could comment on whether it makes sense to do a covered call strategy on ETFs versus an individual stock. I just feel like with an individual stock, there's more potential for volatility. And so, a more likely chance that it could be in the money or lose money on that option versus an ETF where there's maybe less implied volatility, a lower premium, but safer overall. So if you could just answer those two questions, that'd be awesome. And I'll listen in. Thanks, guys. Bye.
All right. So your first question was basically about selling a covered call in some way. Most of it's a long covered call where you're, a long position, and then you're selling a call option. You're short a call option. That's a covered call. And, does the premium adjust your cost basis on the underlying position? I guess you could say that. It depends on how you want to look at it. In the view of the IRS, there's separate positions. You're long 100 shares of one of the stock, and then you're short a call option. So it's just kind of perspective there. What you look for good companies, good businesses. That's most important, is the underlying business that you are investing in. A lot of people chase implied volatility, they chase the high premiums so that they can sell call options on. That typically is a losing strategy if you're just focusing on that. So you don't want to do that. Can you do a cover call on an ETF? Absolutely. If there are options traded on that ETF. And it is certainly lower risk. Why? Because with an ETF, you are instantly diversified. You don't own one company, you own a mix of companies. And that's why the overall premium is going to be lower, because the volatility of that ETF is going to be lower than one individual name, because there's not earnings that's going to move that stock up or down, or that ETF up, down 5-10%, like it would with an individual position. Can you do that? Sure. If you're okay with that lower premium and you want that instant diversification, you don't want to do the deep research on the individual name. So I guess that's probably my basic answer there. Anything to add, Luke?
I would just add that generally speaking, when you're writing an option, when you're writing a call option, you're essentially hedging a little bit, right? So if the price of the stock goes down, then your return goes down by a little bit less because you get that premium. And so generally you benefit the most from writing a covered call when the price of that option, or rather the strike price, is below or at or above the market price. So they're not going to call it. You still get the premium. You don't lose the security.
Yeah, and when you're selling those calls, it typically is better to sell the shorter dated options as opposed to longer dated. So I would encourage that as well. Options are infinitely complex. You can make them as simple or complex as you kind of want to be, but you make sure you know what you're getting into. And most important is that underlying security, not the rigmarole of the call option selling. All right, let's go 2 in a row here on InvestTalk.
Hi, Duncan from New York. Thank you for all that you do. I'm just calling about stock ticker SMLR, Semler Scientific Incorporation. I know it's a growth company. Just wanted to get your 2 cents. I know growth is probably not in favor right now, but they have been kind of beating their estimates for the past 4 to 6 quarters. So looking forward to getting some insight. This is going to be a long-term play. Thank you very much and have a good day. Bye.
Interesting. Semler Scientific. It's engaged in providing technology solutions to improve the clinical effectiveness and efficiency of healthcare providers. It's focused on developing, manufacturing, and marketing proprietary products and services that assist customers, including insurance plans, physicians, and risk assessment groups in evaluating and treating chronic disease. Sounds like to me, Luke, they're looking at maybe big data to try to improve medical outcomes. Is that what they're doing here?
Yeah, that's what it sounds like to me as well, and really digging down into the fundamentals of the company. They have no debt, and when I mean no debt, they have no debt, which is good.
Yeah, they have
it seems to me like they're exactly. It seems to me like they're
$50 million.
They're trading at a reasonable multiple, though a little high for the sector comparison, and they're making some good money. I mean, their EBIT margin's 35%. That's pretty good.
Mm-hmm. And their enterprise value EBIT is only about 8.5. That's not bad for something that it's growing. I don't know if I would call it a huge growth name. Their business is a bit up and down. You know, they made $1.74 in 2020, $2.12 in 2021, then only $1.79 last year, $3.44 this year. So what I do like is the technicals are improving, making a series of higher highs and higher lows. I like what Luke said, no debt on its balance sheet. So that's nice. So I'm okay with this one. I like the profitability and the multiple seems fine for me. All right, we're heading into our final break. So get your questions in now at 888-99-CHART.
You've got finance and investment questions, and Justin Klein and Steve Peasley are ready with their unbiased answers. Don't forget to call InvestTalk, 888-99-CHART.
Hi there, Steve, Justin, and Luke. This is Matt from Minneapolis. The other week I called in and Justin and Luke answered a question I had on possibly purchasing either Adobe or ServiceNow. In listening to their answer, I heard Luke casually mention out Microsoft. Incorporating all 3 of those stocks together, then I got thinking maybe it'd be a safer play for me just to take an ETF in that sector. I was looking at VGT and XLK. Those both are kind of the same sectors, just different fund families. What would you do? Would you put it in one of those funds? Thank you for your answer. I look very forward to listening and gaining your knowledge on the show. Have a good day.
Are you looking at VGT or XLK? And the caller is correct. These are pretty much one and the same. One is a Spiders ETF. The other is a Vanguard ETF, but both in the technology world, large cap growth, which has had a great year this year, but a terrible year last year. And I actually saw some recent data. This is the most overcrowded the tech industry has been within the hedge fund industry in history. So hedge funds are all in on tech, and typically that is not a good time to be investing in this space. Now, Luke, obviously this would be safer than just buying an Adobe, right? Because you're getting diversity.
It would be safer because you're getting diversity. And I also want to kind of add a caveat there that although they both do invest in tech, they are pretty different funds. So XLK has 66 names, and its top 10% weight is 70%, whereas VGT actually has 320 holdings, and the top 10 is 60% of the fund. So if you're trying to get as much diversity as possible, VGT is the answer there. If you want to be more focused in the largest of the large tech names, then XLK is what you want to go with. So it really just goes down to what you're looking for.
Got it. Okay. Yeah, I would agree with that. I think VGT is definitely a better, more diverse name, but I don't think either are great to buy at the current time. All right, now let's touch a bit about the jobs market. And what's interesting as of late is that the jobs data has been weakening. It still is positive, but mainly that has to do with the healthcare space. In fact, you can broaden it out, the whole report. Healthcare, government, and leisure and hospitality, as for the October data, were the only sectors that provided gains. The rest of the overall economy had no net job growth. And this is a worrying trend. Healthcare payrolls rose 4.2% in the 3 months through October. That's up from 3.1% in the first quarter. But outside of the healthcare, grew only 1.3% during the 3 months up to October. That's down from 2.4% in the first quarter. So, Luke, what we're seeing here is that the non-cyclical parts of the economy continue to do fairly well, especially healthcare, because of the demographics of, baby boomers retiring. But the rest of the economy is not doing nearly as well. In fact, healthcare providers accounted for 30% of U.S. job gains in the 6 months through October, even though they are only 11% of the total country's employment. So what is this telling us about the near-term aspects of the economy as well as the long-term secular dynamics?
Well, everything you said is exactly right. If you think about what happened to the healthcare sector in the past 3 years, like you mentioned, you have aging demographics of workers. You also had a lot of people who were burned out from COVID. And so a lot of the hiring within healthcare is trying to feed back into what they've lost for those two reasons. But I think this just goes to having a deeper understanding that just looking at a top-line jobs number is not going to tell you much about the economy. With healthcare, government, leisure, and hospitality leading the way, but primarily healthcare and government are not sectors that tend to expand and signal economic expansion broadly. So you really need to dig deep into the report to figure out where these jobs are coming from to get a broader picture of the overall economy.
And that's why the devils are always in the details. And what we've been saying for a while, it doesn't make sense for the Fed to keep hiking as the cyclical parts of the labor market remain pretty poor. And I don't see that trend reversing until we get Fed rate cuts, probably happening next year. What's interesting about this, the recent data, though, is that in the healthcare space, quits are increasing. They're up 22% from their 2019 averages. So people are getting burned out as well within this space. All right, I'm Justin Klein with Luke Guerrero. Luke completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play, and be sure to rate and review as well. Independent thinking showed success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of